Good evening, everybody. Thank you for making the time to join the webinar. So this is by far and away the singular most popular topic we have. I think we've had many conversations on it so far this week, and I think many people have booked into my diary to discuss this very subject. So I like doing these webinars mainly because it allows me to talk to many and reiterate our stance, or the Heath or Green stance on this. So what you're going to get today is a balanced approach. What you're not going to get today is a sales pitch for why one is better than the other. What the goal for us today very much is for you to walk away understanding why you would do one or the other. And that's really important to me, because I need you to understand why we would do or and won't do anything. As always, please do not ask questions that lead to any tax avoidance. If you have a very specific question, feel free to ask it, but we'll probably address it offline. The format of today is very much going to be me talking for about 30 minutes. We're going to introduce Vinay Rathod to talk very much about the implications on these things, on things like buy-to-let mortgages, insurance, life insurance, income protection, that kind of thing, and certainly things like mortgage applications. So save your questions till the end, and there will be a 15-minute Q&A at the end. If we can't answer everything on the call today, I will get back in touch with you offline. Thank you very much. So the first thing to start with is limited company or sole trader. There's a lot to consider, and the first thing we look at is the tax rates. So as a sole trader, you pay nothing on the first £12,500. Anything up to 50k, you're then paying tax at 20%. Anything beyond 50k up to 125k, you're now paying tax at 40%, and anything over 125k, you start paying tax at 45%. Now the dividend rate works a bit differently. So on the first £12,500, you still get your tax-free allowance. You then get an additional dividend allowance, which for this year, for the year ending 23-24, will be £1,000, and for next year it'll be 500 quid. So not much to write home about, which is why I'm not even put it in. And then up to £50,000, you're paying dividend tax at 8.75%, so really cheap compared to income tax. The tax thresholds are the same, so between 50k and 125k, the dividend rate is 33.75%, and anything you earn over 125k is then 39.3%. Bear in mind, you've got to pay corporation tax first before you can access the dividends. You got national insurance, so up to the first £12,500, it's nothing. Then up to 50k, it's 9%. That may be dropping down to 8%. And all of this might be due up for renewal when the spring budget comes out next week. So this is based on the information we have today. And then you're paying 2% really in perpetuity thereafter on anything you earn over 50k. You then pay another classification of national insurance, which is it's a flat rate of £3.45 a week for every week you're self-employed. Corporation tax. Now, corporation tax is 25%. So it went up to 25%, but you get something called marginal relief or tapering relief. So if you have income up to £50,000, you qualify for the small profits relief with a small profit threshold, which is 19% on anything you earn up to 50k. Between 50k and 250k, in essence, you're paying a tax rate of 26.5%. So 19% on the first 50k, 26.5% between 50k and 250k. Once you hit 250k worth of taxable income, it's then 25% on the lot. So it then tapers up. So from 19%, when you start adding back all the 26.5%, as you get to 250k, it'll just turn to 25% thereafter. But those are the rates you've got to consider, and those are the rates we're using today. Now, every example you're seeing here today is going to be for illustration purposes only. So on £50,000 profit, what would you pay? Now, the first thing we're going to do, we tend to ignore the implications of things like student loans within this, because it can give a very misleading calculation. Any reduction in student loan is not a savings, it's a deferral, so we don't even factor that in. So as a sole trader, you'll pay tax and national insurance of about £11,000. So national insurance of about 3.5, tax of about 7.5, total to pay of £11,000. Now, what would that look like if you were to operate via a limited company? Well, on £50,000 worth of profit, your salary is taken into account, so it reduces the amount on which the company pays corporation tax, and I'll go into a bit more detail about how that looks later. But on a like-for-like basis, company pays about 7.7k in tax. You pay about £2.5 grand in income tax, which is total tax paid of £10,279. So £759 saved. Is it worth it? You got to consider these things. It says when you factor in things like the increased admin time, the increased costs, accountancy fees. Typically for us, the account fee is double for limited company versus sole trader, and then you've also got to consider things like impact on borrowing. is if you're going to switch to a limited company to save £759, but then you miss out on getting the mortgage that you want, was it even worth it in the first place? And that's what we're going to talk about today. In the ephemeral words of Missy Elliott, was it worth it? So when we look at the pros and cons, did I spell pros and cons right? Don't know. Anyway, when you operate as a sole trader, it's dead straightforward. Your default position, it's easier because you're only considering one set of books. The paperwork's a lot less because really when you're submitting your self-assessment HMRC, it's just your self-assessment. You haven't got to submit a separate set of accounts to Companies House. Tax efficiency, well, it depends, but that sort of leads towards limited company, and we go into a lot of that today. And then for sole trade, it's private. If you operate by a limited company, you disclose the information to Companies House. That information then becomes public record. Anyone can search it online. Typically, depending on your level of profitability or revenue, will determine how much information they can see. But that information is online. And then, whereas sole trader, none of that. No one can see what you're making or anything like that. Limited company, risk management. Now, beyond tax, we talk about risk management. So as a sole trader, you are liable for all the risk and rewards of the business. So if the business does really well, that's on you. But if you get sued, then personally, you're liable for whatever you're getting sued for. So things like your house, your personal assets, all that then come into the fall. Whereas as a sole trader, whereas as a limited company, that risk is borne by the limited company. The limited company is a standalone entity, it's a separate legal entity to you that trades. It bears its own risk and rewards. And if that gets sued, they can't come after anything more than that's contained within that limited company. And certainly from an admin or cost perspective, it's far cheaper to operate as a sole trader than it is to operate by a limited company. So there's a lot to consider. So we go into the tax efficiency. So there's a couple of things to consider. So the first is what you'll see here. There's quite a few numbers on the screen, but what we've got, we've got different levels of profit in column 1. What tax and NI that would generate in column 2 under that ST column. Limited max. Basically, if you extracted all the money out of the business, and that final column is whether you would have saved money or whether it would have cost you money. So at 50k, you're about 700 quid up, which we said was about 759 quid, but for 700 quid, we put it for this. At 75k, you're 900 quid up. At 100k, you're £1,500 down. Now, if you go back, if you remember the earlier slide, we're saying you're going to pay corporation tax 19% on the first 50k, 26.5% between 50k and 100k, and then you're typically going to pay 8.75% on anything you've taken out up to 50k, and then 33.75% on anything over 50k, which is why we have to consider, what you want to do with your money when we do these calculations. But at 100k, you're actually 1,500 quid worse off. This isn't factoring in any additional fees or costs or anything like that. This is just pure tax. Like you would be about 1,500 quid worse off if you extracted all the money. At 125,000 pounds, it goes the other way. And this then takes into account things like loss of personal allowance and things like that. But you're about 1,200 quid up, and then 150k, you're 3.5 grand worse off. So typically, what we say, and our stance on this always from a tax perspective, is if you need all the money you're making, it's not worth it. So why bother? Why do people do this? Well, the short answer is there's a number of reasons, and things like these webinars are really to educate you on why, on the type, on the thought process you need to go down on why this is worth it for you or not. What we don't want to do is, if you then book in and have a conversation with us, we don't want to go over this point of principle. The goal for these is point of principle for you to go away, do your own research, and then go back and speak to your accountants or speak to us. Don't speak to us. The choice is yours. So limited company versus sole trader, similar table. So bandings on the first column is different levels of profit, what that would have cost you as a sole trader, what that would look like if you operated by a limited company and only took out £50,000 a year. And the final column is the saving. So the first doesn't change at 700 quid saving, because really after corporation tax, there's not much more to take out. So you're under 50k anyway, so it is what it is. At 75k, you're about 4.6k up. At 100k, you're 8.4k up, as in you've paid less tax. At 125,000 pounds, you're about 17.3k up. At 150k, you're 22.5k up. Now, this is just an example that says if you only need 50k at your company, these are the taxes you'd pay. Now, bearing in mind, if you operate by a limited company, company's a separate legal entity, it makes its own money, it pays its own taxes. Once it's paid tax, whatever's left over can come back to you in the form of dividends. the singular biggest benefit of operating by a limited company from a tax perspective is you get to control how much of that money you take out. Whereas a sole trader, you tax on it whether you want it or not. So if you're quite comfortable living off 50k and you make 100k, well, then a limited company from a tax perspective can make sense, because in that scenario, you're saving about 8.5 grand a year. And the more you make, and I mean, this side of the equation doesn't change. That limited company, if you still need 50k, whatever happens here, if that number keeps growing, then your savings get bigger. And they're only savings because you haven't taken that money out of the company. So how much money is left in the business? Again, similar table, but that final column is reserves. That money's not yours. That is the company's money. So we've got profit, but sole trader, what you'd pay, because it's default, you're going to pay tax on it whether you need it or not. Limited company at £50,000, what you could potentially save or lose, but it's a saving in every scenario in this. And it typically is a saving in every single scenario over £50,000 if you do not need all the money you're making. And then you've got money left in the company. So at 75k, you save 4.6k and there's 11 grand left in the company. At 100k, you've saved 8.4k and there's 29.4k left in the company. At £125,000, you've saved 17.3k and there's nearly £48,000 left in the company. At 150k, there's 66k left in the business and you've saved 22.5k along that journey. This is really key to demonstrating where the potential savings are for you, because the reason why I set that threshold at 50k is because it's 8.75% up to 50k. Anything over 50k, you're now paying 33.75% on. So the math becomes pretty straightforward at that point. That says if you need another 10k, you're going to pay £3,375 tax on it. Now, in that 75k column, ish, is does it become worth it? If you've got to pull it all back out for all that effort, does it become worth it? So if you don't need it, you're not going to pay 33.75% tax on it, and you'll leave it there. Now, there's probably people thinking right now that says, well, what if I add my mum on the books? What if I add my dad on the books? What if I give those dividends to my mum, to my dad, to my gran, to my sister, to my pet bulldog? We will cover that, and this is where things like considerations after the fact come into it, and you've really got to consider whether those things are the right thing to do. We typically don't promote that kind of thing because it's fraught with danger. We'll come to that at a later date. But this is typically what you could save. One thing I would ask is if you enjoy this content and the education you're receiving, is if you take a picture, share it on your socials, and tag us at Heath or Green. I would appreciate that. So is it worth it? Now, in that scenario, if you fast forward 3 years that said, today, I do not need all the money I'm making, but do not need all the money I'm making, I'm quite comfortable living off £50,000 a year, then I've saved that money on that journey. So at 100k in this example, I would have paid £32,000 of tax as a sole trader. Instead, I paid 23.2k, saved 8.4k, and there's 29.4k left in the company. Fast forward 3 years, assuming I don't take any more money out, there's now 88.2k left in the limited company, and along that journey, I saved 25.2k in tax. Brilliant. You think, big pat on your back. I've saved that money, and there's now down near 90k left in the limited company, and I'm as happy as Larry. But what if you need to take it out? So whenever we have these conversations about limited company sole trader, there's typically a few key considerations, and we go through them in quite a bit of detail. But if all of this is a deferral exercise that says, I don't know, you're planning on buying a house, you're planning on moving home, I don't know, you've got some investments you want to make personally, whatever it is, if anything requires you to need that money out of the business, then all you've done is just kick the can down the road. So in this scenario, across 3 years, you built up 88.2k in the company. You saved 25 grand along the way, but in that third year, you then need the money out of the company. So, but now you're going to pay tax on it. Now, bearing in mind, you're now crossing two thresholds. So you're now paying 33.6. So you've already had your 50k. This is assuming you're going to take your 50k that year anyway, or take it all out in that year anyway. This now pushes you 33.75%, but it then pushes you into the 39.3%. So assuming you're only going to take 50k out plus this 88.2k, but the reality is if you need all the money out, then you've taken everything out in that year, which we've already determined you were worse off anyway, or it was never worth doing. But this would trigger at least £30,000 in tax. So every year for 3 years, you save 25k, and then that final year you took it all out, so you're 5k worse off. So that's 3 years worth of admin, 3 years worth of accountancy fees, 3 years worth of headache for it's cost you 5k anyway. And this is the bit to demonstrate is if you need all the money you're making, it's not worth it. And if you think you don't need it now, but you might need it in the future, that's really important to think about as well. Because forward planning is really important now. Tax strategy and tax planning is a whole industry. Tax avoidance illegal. Tax planning is a whole different thing altogether that says, you take a step back, you sit with a wider lens and consider what are your next options. Now, I'm 38 years old. I can't go by myself. Okay. I'm 38 years old. I'm married, got kids. I own my home. I've got no debt to pay. Alhamdulillah. But what that means is my income demands or my spending requirements are really, really predictable, which is the house costs, what I spend on cars, typically holidays. Other than that, between my wife and I, we have a pretty predictable expenditure for the year. We've got nothing on the horizon that we can't invest through the company. And that's the bit that we talk about before. This is the bit we talk about next that says, if you need to take that money out of the company to do stuff personally, what if you don't need to take it out? What are your options then? What can you do with the money? Well, there's quite a few things you can do. Typically, some people will say, I'm just going to chuck it into a pension, but you could have done that as a sole trader anyway. If you've been following my stories recently, really good way to manage your tax thresholds and consider paying into a SIP or any sort of private pension as a sole trader. That shouldn't be the key consideration. We hear this a lot, and people will say, "Oh, operate by a limited company and start taking on employees." But you can also do that as a sole trader. But I can use that income to buy stuff, but you could have done that as a sole trader. Because typically, if you go buy something through the limited, let's say a set of loops, let's say you're going to pay £7,000 on a set of loops, you pay £7,000 on a set of loops. By the limited company, you save in corporation tax at 26.5%, depending on where you are, but let's say 26.5%. But if you did that if you did that as a sole trader, you were saving tax at 42%. So where's the trade-off? And then consider things like, I'm going to go spend 15 grand on training courses the next couple of years. But you can do that with both. The type of, we hear this a lot. The type of expenses change if I operate by a limited company. In the round, they don't. The singular biggest one is things like electric cars. And the other one is how pensions are treated. So if you were to put 10 grand into your SIP as a sole trader, the government uplifts that by 25%, so turns it into £12,500. You then take 20% of that off your tax bill and you save money. Now, on a like-for-like, if you were to then pay that through the limited company instead, you can't claim the uplift, but then you save the corporation tax on it. So if we talk about sort of real terms in money terms, your pension ends up with more money if you provide it into a SIP. But you've got to consider what your goals are. Are your short-term goals to save as much cash as possible, or to put as much cash away as possible to save for a rainy day or save for your retirement? These things you've got to bear in mind as well, because if you did that through your SIP and got the uplift and then compounded that over 30 years and still took out all the money, again, was it worth it? What can you do with the money? Quite a lot, to be fair. Property investment. So property purchase is one of the singular biggest ones. We would say this is a potentially good idea. So in that scenario where there's about 30k left in the company, you saved about 8.5k in tax at 100k, that's £8,500 more you now have towards your investments. If you're going to do buy-to-lets, you can set up another buy-to-let company, an SPV, and Vinay is going to go through this in a bit more detail, but you can set up an SPV, which is a special purpose vehicle, loan money from your limited company into the special purpose vehicle. Because it's a loan, there's no tax to pay. You then use that to buy or invest in buy-to-lets. Now, there's a couple of things to consider on that. First is, if you were to invest in a buy-to-let in your own name, one of the biggest differences, the first is, as a sole trader, you cannot claim the interest as an expense, but you do get 20% tax relief on the mortgage payment. So if you pay 10 grand in interest payments on your buy-to-let, instead of saying I made 15 grand, I paid 10 grand on my interest payments, I pay tax on the other 40%. It doesn't work that way. So on the remaining 5k, it doesn't work that way. The 15k is what's taxable at your rate of tax. So if you're under 125k, you pay tax at 40%. If you're over 125k, you pay tax at 45%. That tax is then calculated, and then you get 20% of that 10k off that tax bill that's generated on that investment. So quite a lot to take in there, but the key thing to consider there is, as a sole trader, you can't claim the interest as an expense. Via limited company, you can. Operating via a limited company, you're then paying the profit on that tax at a lower rate. So instead of paying that tax at 40% or 45%, you're paying that tax at 26.5%, or if it's a separate limited company, potentially at 19%, depending on how the margin relief would work in that group structure. But that's another conversation for another time. So that's really useful. But if you said, Bilal, my goal is to take that money start investing it, and I need that. I want to start investing in buy-to-lets. I don't want that money out of the company. Well, then you factor in the extra dividend rate. Was it worth it in the first place? So yeah, we're going through signposts here. We're going through sort of a mind map that says, don't need all the money I'm making. I've got money left over. I know what I want to do with it, and I don't need that money today. So this is all investment strategy. And across the next 10, 15, 20 years, as my dental income makes loads of money, I'm going to funnel it off into all these other areas, and I'm going to use that money to then, as I sort of wind down my dental, I'll then start drawing down from my investments. And that's where that long-term strategy comes into it. If you want to do things like a practice purchase, I would question what type of practice you want to buy. So if you said, Bilal, I'm going to go buy a NHS practice, I'd say fantastic. You cannot use a limited company's money to do that, because the NHS contract cannot be in the limited company's name unless it's incorporated. So you're going to have to pay that money to yourself and pay the tax on it to then do the other thing. So we have to then consider what type of practice you're buying. If you said, Bilal, I'm going to buy an NHS practice, but I'm also going to buy the freehold, well, then that goes back to property investment. So you could use the money to do that. So where you go with all of this is really important. Diversification is the other thing that says you might want to invest in other businesses. You might become a dentist because your parents made you become a dentist, but your goal is to have the best vegan burger in the southeast, and you could use that to funnel off into other companies. Where that then becomes useful is if you've got your main trading income, it's profitable, and you're diversifying into other businesses, and the ownership is the same. We would then look at group structures in this, but again, another conversation for another time. You can offset the losses in one company against the profits in one, but you also could have done that as a sole trader. So depending on what the long-term goal is, and then other investments. So had a conversation with one of our clients this week on crypto. So if you expect your investment to 10x, I might say take the hit up front on pulling the money out of the company and invest in your own name. But purely from a tax perspective, that says, well, you'd be paying capital gains tax at 20% as opposed to corporation tax at 26.5, or potentially 25, and then paying dividend tax to take that money out. So it depends on what type of investment you're going to make. So you could do things like potentially buy watches, but also I'd question whether a limited company is the right vehicle to buy watches, because there's certain classification of assets that don't draw any capital gains tax because they're considered personal assets, and the definition of that is sort of neither here nor there. But sort of three big ones that meet that category: things like art, cars, and watches. So if you manage to get, I don't know, a Patek for £36,000 and then later flip it for 100k potentially, that gain is all tax-free. So was it worth taking the hit on the tax up front to then making the investment afterwards? What type of investments are you planning on making? All these things are really important. It says if you're going to get really consistent growth, or you're expecting sort of, let's say 5 to 10% growth a year on these investments, maybe some losses, maybe some gains, but those are the sorts of things you're looking for, then having that extra liquidity at the start will give you a better investment portfolio at the end. But again, the food for thought element here is there's more to consider beyond what it is you're doing. We have to take a step back. We have to look with a wider lens. The goal for me for any conversation is you walk away knowing more than you came into it, and that's important for me. This is vital. So key considerations, and I mean this with no disrespect, are you bad with money? We could do a like-for-like calculation today that says Mr. or Mrs. XYZ can quite comfortably live off 50k, but they've spent a shed load of money in the year before. So let's say, let's use the 100k example. So we're coming up to the end of this tax year. On the 5th of April, you made 100k. I'm saying you've got a £32,000 tax bill coming up because you made 100k as a sole trader. Fine. Have you got that 32k in the bank? No. Why? I spent it. Bought a house, needed the money for the house, and I'm going to use the money that I'm making over the next couple of months to pay for to pay that tax that's due. Right, that's a really bad idea now, because you don't need 50k anymore. You need 50k to live your life, but now I know you need another 32k at the company, which goes back to the earlier point. You need all the money out of the company to pay your tax bill. If you're quite good with your money and you've put your money away, and you put your money away, and you're pretty good at putting your tax money aside, then that's a consideration we would make that says we just want to see that you put that money aside, and we need to know that. And again, why this is really important to us, we'll come back to in a second, where we did a calculation for one of our clients, I think he made about 300-400k profit, and he to maintain his lifestyle, or her lifestyle, their lifestyle, 130k was about the number. The tax savings were phenomenal, but when we went through all our process and our procedures, They needed the money to finish off doing the house. They needed probably another 50k to do that. They'd spent all the money already buying the house and doing the house up, and they needed another 50k to finish it off, which meant they got a 100k tax bill in Jan, which they don't have the money for, so they're entering into a payment plan with HMRC. So once we add all of those things back together, they actually needed all the money at the company, and had we done that, they'd have been about 22 grand worse off. It did not make sense, so we don't do it. So if you're bad with money, the other thing to consider here is how do you manage your finances? And as I did say, we'd go through how you get paid as a limited company. Now, this is purely for illustration purposes only. Don't pay too much attention to the salary figure. That salary figure is there at 9,100 because at that amount, it doesn't attract any national insurance or trigger any employer's national insurance. I don't want to put it at £12,500 because it triggers far too many questions at the other end. But typically, the tax-free threshold is 12.5 grand. If you pay yourself £12,500, you will trigger about £500 worth of employer's national insurance, which is taken as expense through the business. But for simplicity, we'll go with this number here. So let's say you made 100k. You paid yourself a salary of 9,100 because there's only really three ways you can get money out of a company. 1, salary. 2, dividends. 3, expense repayments. It is what it is. The fourth, it comes down the line when you liquidate the company, you take a distribution, but that's sort of unwind up. But so, well, the fourth one, you've got loan repayments, but that's a separate thing altogether. So in this scenario, company's made 100k, paid you a salary of 9,100, which is an expense to the business. Now the taxable profit is then £90,900, which triggers tax of about 20k. So that tax figure is £20,000. Now you want to pay that tax because it's not due for like 9 months after your year end. So if you use a calendar year, if you set the company up on the 1st of Jan and it ran to the 31st of December, that tax isn't due until the following September. So, but that money's in the bank somewhere. So what's now left over is the £70,562 left over. You take out £70,562. You've had 9,100 salary, £70,562 worth of dividends, just shy of 80k on your self-assessment, on which you now pay income tax. Company pays corporation tax, the individual pays income tax. That income tax works out to about 13k. Now, the bit to consider here is if you're bad with money, is that tax figure. And we have seen this time and again, is if you're not good at putting your tax money aside, you can get yourself caught in a very, very, very bad position that says on 100k, you had taxable profit of £90,900, there was 20k in tax to pay, and you took that out alongside your £70,562. Dividends can only be paid in what's called profit after tax or distributable reserves. So whatever the profit was, allow for corporation tax, that pot of money now left over is yours to do what you want with. You can declare as a dividend, you can leave it in the business, you can take part and part, you can do what you want. This is where the flexibility and control comes into it. In that 100k scenario, which we said earlier, you were going to be 1,500 quid worse off. We already said that, we know that. However, if you now then take out that 20k as well, that then triggers something called an S455 charge, which is a director's loan charge, which is a holding tax the company has to pay on your behalf until you repay that loan. It's considered a loan because it can't be a dividend because there wasn't enough money to declare as a dividend. So £20,339 at 33.75%, that triggers a director's loan charge, so which the company pays. You get it back once you repay it, but how are you going to repay it? You're going to have to declare the dividend. There would have to be enough money for there to be dividends for you to pay it, or you declare it as salary. This then gets super messy. But in the round, you're about 8.5 grand worse off now. Now, as a sole trader, if you had spent all your money, you'd have contacted HMRC and said, Mr. and Mrs. HMRC, whatever pronouns they use, I can't afford to pay my tax. I would like to enter into payment plan. And you enter into payment plan and you do what you got to do. But it sort of works a bit different with the company. If you're not very good at managing your money, if you bury your head in the sand and wait for it to come to you, it's probably not the right thing for you. Going back to one of the earlier slides, ease of use, sole trader might be the easiest thing you do. Key considerations beyond that says, let's assume you don't need all the money you're making, you've got a plan for what's left over, you're good with your money. What can you do with it now? What beyond that do I need to consider? So, do you need the money? I cannot stress that point enough. A lot of people, when considering how much money they need to live off, always forget holidays. What tends to happen is every year as well is they come up with quite an aggressive, I'm going to invest in X, Y, and Z. It'll probably come to the end of the year and they'll make a knee-jerk pension contribution, or they'll pull the money out and put it into their ISA. I've got no issue with that. We're not financial advisors. We don't tell you what's going to give you the best return. Ours is to make sure you walk into that decision with your eyes wide open. That says, I would rather take the tax hit, pulling the money out, put it into my ISA and let that grow tax-free, and I can pull it out tax-free. Fine. If that's the strategy you come up with your financial advisor, I've got no issues with that. I just want you to make sure you know what you're doing. So do you need the money? What's on the horizon? What's coming? Do you potentially need the money? What's coming? If you have a belter year, are you going to pull the money out and go buy your forever home? Those are considerations. IR35, one of the biggest ones, is let's assume all of this you've answered in the affirmative. IR35 still rears its ugly head, depending on what side of the fence you sit on. But IR35 really states whether you can operate via a limited company or not. So for dentists on the call is if you control how, where, why, when you work, if there's no mutual obligation, they don't have to give you work and you don't have to take it, and you have something called a right to substitution that says, whilst I work for Vinay Dental and I've got the contract's in Bilal's name, I don't fancy working, I want to take some time off, I send my mate in, he's a qualified dentist, he's got the right insurances, that's on me to check because that's an indemnification. He's all good to go. He just finished off my treatment and the practice can't really have an issue with that. But if the practice is going to govern how I work, the materials I use, I have to give a certain number of service days, I can't send a substitute in, well, then limited company is not really an option anymore. So you've got to consider IR35. Now, beyond that is things like borrowing implications. Bang on time, this almost has never happened before. So things like borrowing implications, we had a conversation, I think he's on the call today, I'm not going to air him out, but we went through the numbers. We saw a pathway to about 35k tax saving, but there's things on the horizon that will be significantly impacted by switching trading status, and that's his decision to make now. But again, he understands the implication of the decisions, and that's the most important thing for me. I mean, the biggest compliment to us as a business is when you're sat around your peers and someone says, "Oh my God, you should be operating by a limited company," you can quite confidently say, I've gone through the numbers, I understand the implications, and it's not the right thing for me yet. And again, why that's important is when those circumstances change, you understand when it does become the right thing for you, and you prompt a conversation, and we could do something about it. Burying your head in the sand is never an option. So, borrowing implications. Can I, if you're going to switch to a limited company because you're going to go buy a Porsche Taycan, you can do a 100k tax write-off. I've got a separate webinar on that. It's worth watching. Of course, I'm going to say that's my webinar, but don't go buy 100k to save. Don't go buy a 100k car just to save a tax. It makes no sense. But again, we have evidenced by switching to a limited company, there's no guarantee you're going to get the funding for the car. So you've done all of this to go buy a car that you didn't need, and now you can't get funding for it anyway. And then to unwind it all is going to be an absolute ball ache. So you make sure you've got to have conversations with your practices that says contracts have to be in the limited company's name. Everything has to be beyond that. And there's also sort of other considerations that says, well, actually, let's assume you can save 10, 15 grand a year. If your income's predominantly NHS and you want to stay in the NHS pension scheme, you have to opt out if you want to switch to a limited company. So that then means missing out on the NHS pension scheme, but also if you're female, then missing out on the MAP pay. Is it worth it? In some scenarios, it can be. In some scenarios, but we need you to make sure you walk into these conversations with your eyes wide open, because you've got to consider whether these things are worth it or not. There is sort of a meet in the middle scenario that says you can run your sole trader for your NHS and you're private through the limited company. But again, it depends on so many different moving factors whether it's worth it or not. But on a like-for-like basis, you lose about £1,500, £2,000 worth of tax efficiency. So again, you've got to decide whether it's the right thing for you or not. And then things like income protection, have you made considerations for what impact this is going to have on things like your life insurance, your income protection, or anything like that? This is where I hand over to my man Vinay at VR Financial Solutions. I'm hoping he's on the call because it's going to be really embarrassing if he's not. There he is. Vin, floor's yours, my man.
Can you hear me?
We can indeed.
We can. I've not got anything on my screen to show, but can you do the camera?
Yeah, my screen's still visible. Actually, no.
As in, can you hand over to my camera, or?
I don't think I can. You should have.
That's all right. People can admire your beauty while I speak. All right, so guys, a lot of the info I'm about to give is going to be directed at assuming that the vast majority of listeners are dentists or watchers. So forgive me, I know Bilal has a following of non-dentists as well, so some of this I'll try and highlight when it's applicable only to the professionals and otherwise. So Bilal's discussed, I jumped on about 10, 15 minutes in, apologies Bilal, but so what I caught the rest of, you've discussed the investment opportunity for a buy-to-let, for example, and the potential impact to things like insurance. So we'll start off with the buy-to-let side of things, as I think that that's an increasingly popular means of diverting this accrued income in the business to. So Bilal's discussed the way in which you can structure the business. We're not going to go too much into that. I don't believe you did either, holdings codes, etc. But there are a couple of different ways to structure this. Somebody like Bilal, hopefully Bilal, would be the one who'd be able to advise you on that. But we assume the structure is correct, and thus the following will be correct. So as Bilal mentioned, you get the basic rate tax credit on a mortgage in a buy-to-let in your personal name. In a limited company, the buy-to-let mortgage interest, forgive me, we should clarify, it's just the interest, not the whole payment if it's a capital repayment mortgage. Most buy-to-let mortgages are interest only, and the interest in a limited company is fully deductible against the turnover of the company as any other expense is. So you have whilst you receive the same amount of rental income, you will have less of a profit to pay tax on. But in an accounting sense, you'd have the same profit in reality. You'd have just paid a bigger tax bill if you were a higher rate taxpayer, if you kept the buy-to-let in your personal name. So the profits are in effect going to be larger for you. There's a larger share of the pie, slice of the pie left after the government's taken their hit. And that hit is a smaller percentage as well. It's corporation tax, taxed at from 25% instead of the 40 or plus percent that the assumption that our listeners are higher rate taxpayers will be paying. A lot of people do have concerns that the interest rate in the mortgage on the mortgage in the limited company is higher. It is, but not anywhere near enough to counteract the massive saving by being able to fully deduct the mortgage interest. So there's a slightly higher amount of interest which you're fully allowed to deduct versus a slightly smaller amount of interest which in effect you're getting a half a deduction on via credit. So there's that element. The other element is at the initial investment end of it. You, if you're a sole trader, will have already paid tax on all of your earnings. You'll have saved up, squirreled away. You'll have some money for a buy-to-let deposit. You'll have paid a lot of tax on that money. So in order to get your 50 grand, you'll have earned, I don't know, 80 odd, maybe Bilal, 85 before tax. Whereas in the limited co, once you've paid your corporation tax, the money that sits in the limited company will be able to be put down in full as a deposit. You would set up a separate company. This is a common question. You don't buy the property in the business that you put your dental income into. It's a separate company, an SPV that's specifically there to hold property. You'd raise a mortgage in that business. The rental value of the property justifies the mortgage as well as your background income. A lot of people assume that the company that's taking the mortgage has to have a few years of accounts showing a profit. That's not the case. The mortgages are calculated in much the same way as a normal buy-to-let, except with a more favorable pay rate calculation. What that means is that you will often be able to get a larger buy-to-let mortgage in the limited company due to the calculations that they use in the background from the value of the rental. So you'd have to put down a smaller deposit and you'll have paid less tax to accrue the deposit in the first place. You then pay less tax on the same value of rent going forward. Now, this is a cycle. If you want to build a rental portfolio, you're putting less money in to get the same property, and then you're keeping more of what comes out. And a perfect scenario is to recycle that money into the deposit for your next property. Any money you put into the limited company to fund the deposit and the stamp duty, Bilal, am I correct that it will be a director's loan that can then be drawn out tax-free? Okay, so you get that money back without having to worry about the complications there. So from a buy-to-let perspective, whilst the last, I've lost track of how long it's been now because of how up and down it is for the last few years. But the last 6, 8, 12 months, obviously mortgage rates have been quite high. It's maybe longer than that. Buy-to-lets, a lot of people are still sort of waiting for rental corrections. If you look at the rental values, you've got a lot of landlords whose mortgages are yet to go up, and they'll put their rents up. It will balance, mortgage rates will come down, and buy-to-let will be a fantastic investment again for a lot of people. Maybe a slightly subdued market now, but nevertheless. I'm conscious that Bilal did say he didn't want me to take too long, and I like to talk. So I'll quickly move on to the next thing, which is actually residential mortgages. You should be aware, if you incorporate, you will have, if you plan to buy a house or need to remortgage to raise any money, if you don't need to remortgage to make any changes, your current lender will always give you a new deal at worst case, regardless of whether you've changed to limited or not. So you're not going to be left in the street. But if you need to make any structural changes to the mortgage itself, like borrowing more money, you want to move house or buy a house, if you're a first-time buyer, you'll have a much smaller choice of lenders. Now, as a specialist broker, we have a number of lenders who will still give a mortgage to a dentist who has recently incorporated, and we can look at your historic self-assessment tax returns to base the value of that mortgage on. So you don't need to wait until you've got 2 full years of trading accounts as a limited company. But even after you have got 2 full years of trading accounts in your limited company and you apply for a mortgage, you will have a lesser choice of lenders typically, because the vast majority of lenders will recognize your income as your drawn income only, not the company profit value. So you could be making 300 grand a year profit, and you and your wife, 50-50 shareholders, whatever the accountants advised and structured, you take out 50 grand each, you've got 100 grand a year income. As far as the bank's concerned, you earn 100 grand. They will give you a mortgage based on 100 grand. Now, if you're typically earning 300 grand a year, you'll probably want a big mortgage. There are companies that will look at the salary that the directors take plus the company profit, typically after corporation tax. There is a couple of exceptions to that. The lenders that do that are in the minority. There are many lenders that do that on the high street with very competitive rates. It may be that on any given day, the best rate on the market is with a lender that will be okay with your limited company structure. But statistically, that may not happen because the vast majority of lenders will only lend based on salary and dividends. Again, there are a number of lenders we have that support the value of the salary plus the company profit, and we can work past the issue of having recently incorporated as well, but there will be less choice. And thus, if you want the largest possible mortgage you can get, then maybe wait until you've got that house before you change to a limited company, because through less choice, there is less flexibility. Your situation specifically may be one that can't be as well supported by one of the lenders that are okay with profit value. Income protection we'll move smoothly on to because there's a similar concern. Whilst you're self-employed, your net profit value is the amount of income that the insurer will recognize as you being able to protect. And typically at around 60% of that is what you can insure. When you're a limited company, the vast majority of income protection providers will only recognize your salary and dividend value. So if they're saying they'll pay 60% of a value of income they recognize, and you used to earn 100 grand net profit as a self-employed individual, they'll pay you 60 grand a year, 5 grand a month. You change to a limited company, your earnings remain the same. You don't realize that the income protection is something that needs to be adjusted. So you carry on and you take 50 grand a year out. You could make a claim with your income protection provider, they're going to pay you 2.5 grand. Because if you're taking 50 grand, they're going to cover only 60% of that. You may well have still, as a clinician, been earning the same 100 grand a year as a profit, but they're not going to pay you on that. So you shouldn't assume that the income protection policy you've got will carry on as it is for the amount of cover that you've got in the event of a claim that could turn you down. it has happened to dentists who have found themselves in a pickle. Okay, there is ways to pay life insurance. There are ways to pay life insurance through the limited company as a fully tax deductible expense. You can't just set up any life policy and say to Bilal, get me tax relief on this. It has to be set up specifically as a relevant life policy, and there are certain criteria for it to be tax qualifying, and thus it has to be set up as that type of plan. Income protection, can that be ran through the limited company? I've actually written an entire article about this, and this deserves its own webinar. Some IFAs and advisors will tell you, yes, my opinion is that it is not a policy that is suitable for the overwhelming majority of dentists. It's called executive income protection. And I'd probably need about 15 minutes on my own just to explain why. If you want to know, I'm more than happy to explain individually if you want to get in touch. Was there any other common areas, Bilal, that we have questions around when you are incorporating anyone that I've not thought of?
So hold on, can you hear me? Yeah,
I can.
yeah. So typically it's you've addressed the right point there, which is if you do change your trading status, it does diminish the pool of lenders you can go to, which goes back to our calculations. It says, I don't know, if in the round it means you're going to save £3.5 grand this tax year doing it, but you'll end up paying, you know, £2.5 grand more in interest payments across your mortgage. Was it worth it? The other is if you're really late stage, as in you found the house, you put your deposits down, you're in the process, and they're using your last two tax years. So let's say we're going to switch you over to limited company from the 1st of April 2024, which impacts the 24-25 tax year, which, you know, runs to the 5th of April 2025. And the lenders used your 21-22, your 22-23 tax returns, which would be your last two tax returns. Fine, your income matches, everything's fine. You've now switched to a limited company. The challenge there then, Vinay, I believe, is if the lender then does a post-mortgage audit and they see a change to your trading status, they do reserve the right to
Yeah.
pull their funding, don't they?
You mean if the offer has already been issued and then they
Yeah.
incorporate? And yeah, you may be tempted to think if nobody tells them, then you know what they know won't hurt them. Lenders randomly do pre-completion checks on mortgages. We have no idea when they're going to do it. They could just literally do an internet search and see that you've incorporated on Companies House, or come back to us and say, we would like you to obtain the most recent 3 months of bank statements. In the case of a self-employed individual, they would be personal and business bank statements. And there's when you're going to have an issue, because you'll send in bank statements for a limited co. And if it doesn't happen to coincidentally be one of the very few lenders that are happy with you changing from a sole trader to a limited company, which is very unlikely if you've been a typical self-employed individual with tax returns, they will pull your mortgage offer right out from under you. If you've exchanged contracts, you're then in a very sticky position because you're legally obligated to buy that house on the agreed completion date with forfeiture of your 10% deposit otherwise. So yeah, very, very ill-advised to do it partway through.
Yeah. Appreciate that, Vinay. Thank you very much. So, as Vinay quite kindly offered, if anyone's got any specific questions or queries, please reach out to Vinay Rathod at
Thank you
VA
for
Financial
having
Solutions.
me, Bilal.
There's been always a pleasure, buddy.
Take care. Have a good evening, everybody.
Thank you. So that then brings you back to me, hopefully. Don't know what you can see on the screen. There you are. Perfect. Any questions? So we've got a couple of questions already lined up. How do you monitor how much money you've taken out? Fantastic question. So again, are you good with your money? Really important. So anyone that uses our services will either be on free agent or zero. Free agent zero will give you a running total throughout the year, and that's how we operate. Is we want to make sure you can log into your system and understand how much money you need to have set aside for tax. The rest of that then becomes yours. Typically, if you've set the scene though with us, is we want you to take a fixed amount each month, so you understand what the implications of that are. That says, I don't know, let's say you need 65k net for whatever reason, and we say this is how much you need to take out each month, but this much aside for your personal tax. That's yours now left to spend. The rest of it's company's money. The onus is on you then to tell us if your income drops, because what I don't want you to be doing is taking out 6k when you've built up reserves, but now you're only making 5k. It doesn't make sense. So when you have a significant switch in your trading or your income, it always warrants a conversation to come back in and talk to us. So can you switch to limited mid-tax year? Absolutely. So you would run sole trader. So let's say we were having this conversation in October. So April, May, June, July, August, September, October. Jesus, nearly got that wrong. 7 months would be a sole trader, and then you'd switch over to a limited company. But we would always do a mid-year calculation to see if it's worth it or not. Now, one of the key things to bear in mind is your payments on account. So as a sole trader, you pay advanced tax payment to the year ahead. So if you've got a 32 grand tax bill, you pay 16 grand towards the following year. In that year you make a switch, you'll get a cash flow benefit, but not a tax benefit, because the advance payments can be based on what we project your dividends to be. So if we said it's 50k and we project your self-assessment to be 3.2k, well, then your payment on account's only going to be like 1,600 quid in Jan and July. So that gives you some potential. We factor that into the conversation as well when we have the conversation. Can I invest in stocks and shares through the limited company with profits, or do I need to set up a different limited company to do this? Great question. So depending on what you're investing, how much you're investing, and what you plan on doing with the income, and do you want to class it as trading profits, do you want to class it as income, investment income, when you set up a limited company, you have to set up something called an SIC code. So for dentists, we typically set up dental practice activities. When your balance sheet tips away from being trading income and like quite a bit of investment income, then the SIC code is no longer relevant. So then we would split it out. Depending on also the type of investments you're doing. If you're doing like leverage investments, we'd strongly recommend a separate limited company, because that's then all the risk is ring fenced in that company and it has no impact on this one. So really important to consider. Great question. So to answer your question, it depends on the type of investment. Is LISA included in tax deductibles? No. So it's got nothing to do within that. What about once you purchase your house, can you then become a limited company once contracts have been exchanged and you've been handed the keys to the property? So this is the bit that Vinay was saying, is if you've done all of that and then switched, and then the lender does a post issue audit and sees a change in trading status, theoretically they do have the right to request all funds. Now, whether that happens in reality or not is not for us to suggest, and it's not a risk we would consider worth taking. But typically, if you're going to go through that process and then switch, you run the risk of the lender asking questions that says, why have you changed your trading status? And it really depends on the lender at that point. But that's more of a question from Vinay. Can I move from limited company to sole trader any time of the year? You wouldn't dance around. There are considerations, i.e., you could liquidate the company, shut down the company, and go back to trading as a sole trader. But there's quite a few steps you have to take in that process, and the way the income's treated as it comes out. How does lending work between companies? How does this differ with the holding company? Having the settlement structure with the holding company is easy to do. Yes. So when you want to introduce a holding company, so you set up a holding company, you're then going to do something called a share for share exchange, but you have to get clearance from HMRC to do that. So it's not a simple case of I want to do this and then switch all the shares around and off you go. It really there is a process to follow, but if without the holding company you make intercompany loans, they just have to be at market rate. So there's a predetermined rate for things like intercompany loans and things like that. It can't be at sort of, there has to be a commercial basis for that loan, and they're just between two companies. Now, pros and cons: easy to use, easy to administer. Depending on if you're going to liquidate the company, if you're going to dispose of the company, those loans then need to be settled and paid back. But that warrants a whole separate webinar its own for holding companies, which we will be doing. But great question. Can you purchase 2 and 3 digit registrations through a limited company, and are these investments? As long as you can, yes. So there's different types of asset classifications. If you can hold it and sell it, then it's asset held for sale, but it really depends on the type of asset you're going to be dealing with. Also, if you're going to put it on the car, then that potentially triggers benefit in kind tax, or you would have to benefit, you would have to prove it's some form of marketing or anything like that. I can indeed. Can I run as a sole trader, invest in practice, for example, as an LTD? Absolutely. Great question that says, well, if it doesn't make sense from a tax perspective today, but you want to make an investment in the future, then yeah, fantastic question. That says the bit that we were saying about buy-to-lets, for instance, is, and this is a real scenario that we had. So client was given a large sum of money as part of a wedding gift. That money didn't originate from a limited company, so the tax wasn't there to consider because it was a gift, but they then gave that to the limited company to then invest in buy-to-lets. That original investment for them to the company is considered a loan, so that they can pull that cash out whenever they want, whenever there's enough reserves in the company, and that money coming back to them isn't taxable income because it's a loan repayment. How do you move back to being a sole trader and close the company? you've got to liquidate the company. So there is a process for that. But yeah, so you start the process, liquidate the company. If you then liquidate the company, you have the opportunity to either pay 20% capital gains tax, take the income as dividends, or claim something called business asset disposal relief. Business asset disposal relief gives you a one-off 10% tax to pay on the first £1 million of proceeds. So it's sort of a one-time thing that you want to set up and do right in the first instance. Can you operate a limited company and charge your sole trader NHS income management fees for the NHS profit? Absolutely not. But they're called flawed incorporations for a reason. We don't recommend this because the risk and responsibilities it's so hard to determine with whom they sit that it's just very, very, very murky territory. So this now goes into tax avoidance. If it's not set up correctly, if the contracts aren't set up correctly, you run the risk of opening yourself up to a massive position here where if this happens, and let's say you fast forward and you've been doing this arrangement for 5, 10, 15 years, you've built up loads of assets, HMRC can come in and just seize the assets in the company until you pay up whatever they determine you to pay. So make sure you get good legal advice and get good accounting advice, and make sure whatever accountant told you to do that, whatever lawyer told you to do that, you've got it in writing. Otherwise, it's going to fall back on you. Can I set up a limited co 3 months after house purchase? That's a lender question, not a question for us, unfortunately. So my accountant has my partner set up as a 10% shareholder. Their income is 30k-ish. Plan to take dividends. Next tax bracket, is that good? There would have to be a commercial reason for that person to be a shareholder in your business. Now, whatever setup you have, whatever arrangement you have, it's got to represent commercial conditions. I.e., if it was between you and I, would you just give me 10% of your business? Would I have to buy in? Would I have to be doing something for that business to warrant that 10% shareholder? So this call isn't about that, whether setting up additional shareholders, alphabet shares, bringing in family members, things like that. This call is absolutely not about that, because it's so fraught with danger if you don't get it set up correctly, and we don't want to run the risk of people getting sort of going down the rabbit hole or something they absolutely shouldn't be doing. It's a conversation on a separate. You can reach out to us offline. We're quite happy to have that conversation with you. Can I still benefit from NHS pension and mat leave if I run the NHS contract as a sole trader and the private to the limited company? Absolutely. We do this quite a bit, to be fair. So we call it the Hovis 50-50, the best of both. So mat pay, NHS income stays as sole trader, private income goes to the limited company. What you'll typically find, though, is if the NHS BSA runs a search, sees your name on company's house, it will trigger a question that says, why you operate by a limited company. Typically, they're quite satisfied with a letter from your accountant that says, no, NHS income's going to the limited company, we can prove that. And then the private income's going to the limited company, and we can prove that. What are my predictions for the budget? I'd have even less hair if I made those predictions, unfortunately. But no, appreciate it. So we've run out of time there. So I've put the QR code on the screen. Feel free to follow us on Instagram. And as always, if you share this to your socials, if you enjoyed it, there will be a little poll at the end of this. Your feedback is greatly appreciated. There'll be a number of these happening throughout the rest of the year. So do stay tuned. Really do appreciate your time. And I hope you found value in what we've done today. Thank you very much.